So why don't we go ahead and get started. Tom Smith here from TradeMONSTER. Thanks for joining us. Today we have our special guest, Chuck Hughes. Chuck is probably the most prominent educator that we have here at my TradeMONSTER, and he does webinars with us quite often, and we're very grateful for that. Chuck, are you with us?
Yes. Can you hear me, Tom?
You sound great as usual, Chuck. Thanks for joining us. For those of you that would like an archive of this webinar or a download of this, you would go to www.mytrademonster tomorrow, and I will have that up for you. Otherwise, why don't we go ahead and get started. Chuck, I'm going to go ahead and I'm going to pass you the reins, and we can get started.
Okay, sounds good.
Okay, I see it, Chuck.
Okay, good. I'm going to go into slide mode. Okay, great. Good afternoon, everybody. Thanks, Tom, for setting up this educational webinar. I enjoy doing these every month, and it's a good way for me to review the different strategies and inputs that I get from my members, and I'm constantly upgrading and improving our trading strategy. So this is a learning experience for me as well. So we appreciate you putting these educational webinars on. So today we're going to look at option spread trades. We're going to look at option debit spreads, market neutral spreads, and married put spreads. And then we'll have a Q&A session at the end, and I'll be glad to answer any questions. And I'm going to show you real-time results for these three option spread strategies, over $1.4 million in actual profits using these spread strategies. I currently have $557,000 in current returns, and I'm going to show you those brokerage statements here in a minute, and an additional $919,000 over the past several years using these option spread strategies. So bullish spreads, let's look at the difference between these bullish spreads and directional trades. Now the spreads have a long position and they have a short position. The long position profits as the underlying stock or ETF moves up in price, and the short position profits as the underlying stock and ETF moves down in price. So with these spread trades, it's possible for the spread trade to profit even if the underlying stock increases in price, remains flat, or declines in price. And I'll show you examples of that, how these spread trades can profit even if the underlying stock is down in price at option expiration. And with the market neutral spreads and the married puts, it's also possible to lock in a profit on an existing option or stock trade that guarantees that you'll make a profit regardless of the price movement of the underlying stock. So these are obviously very low risk strategies, and I'll show you examples of how you can actually lock in and guarantee a profit on a stock or an option trade. So spreads versus directional trades. Directional stock trades, obviously they require that the stock increase in price in order to profit. And with directional option trades, they require the underlying stock to increase in price to profit. And during volatile markets, these directional trades can easily be stopped out. I use a money management system. If I buy a stock, I'll usually sell that stock if it declines 10% below my entry price. And with an option, I give a little more room because options are leveraged. So if an option declines, if I purchase an option and it declines 25 to 35% below my entry price, then I'll simply exit. So during these volatile markets, it's very easy to get stopped out of your stock or option trade. So spreads can help avoid getting stopped out. And of course, when you purchase an option, volatile markets can easily result in 100% loss for a directional option trade. You can easily lose that much on an option trade if you have bad timing on when you enter the trade. So a little bit of backdrop here. This is a daily price movement of the S&P 500 index, and you can see that we've had a lot of volatility here. Down moves, up moves, down moves, up moves, down moves, but we're virtually unchanged from where the S&P was trading last year. So a lot of price volatility, but very little trend. So this is the ideal type of market for spread trades because they can profit during these volatile type markets. And if you're trading options and you purchase a call option and you have bad timing during this volatility, you can easily get stopped out of that trade. And today I'm just talking about bullish spread trades. And during the last two bear markets, just keep in mind that we had bearish spread trades. So these spread trades work both ways. We use bullish spreads during an up move in the stock market, and then we use bearish spread trades when the stock market's in a downtrend. And we can profit either way. We have very good profits during the last two bear markets, severe bear markets, using these bearish spread trades. So today we're just talking about bullish spread trades. And here's another example of a lot of volatility, a lot of up and down price movement. This was in 2012, and during this time frame, the S&P was unchanged. So we've seen this a lot in the past. Here's 2011. Again, you can see a lot of price swings, up and down moves, but over this time period, the S&P was virtually unchanged. And in 2011, we had 68 days in which the S&P closed up or down more than 2%. So that's a lot of volatility over the course of a year. But we were trading these spread trades during that time period, and you can do okay when the market's not trending because you have that bearish side of the spread trade, that bearish position that will profit as the underlying stock moves down. So you can profit in these kind of markets using these spread trades. Here's 2010. And again, you can see a lot of price volatility. And over this time frame, the S&P only changed 2 points over this time period. So we've seen a lot of this type of volatility over the last several years. And I think these spread trades should be a part of everybody's portfolio because they can profit during these market periods when the market's not really trending. Here's an interesting snapshot. This was 2011, and the S&P actually started the year at 1257 and ended the year at 1257. So you can see we had a lot of price volatility here in 2011. But the S&P literally started the year at 1257, ended the year at 1257. So we were able to profit using these spread strategies during this period when we had a lot of volatile up and down moves in the market, but the market was not trending. So this is the type of strategy you want to use in this kind of market. So what I'm showing you here is a snapshot of my two retirement portfolios. This was yesterday, and I wanted to take this snapshot just to show you when I took the snapshot, the Dow was down 85 points. The NASDAQ was down 1.66%. So in my two retirement accounts, I have the three spread strategy trades that we're going to look at today. I have the married puts, the market neutral spreads, and the option debit spread. So I thought this was really interesting. Even though the Dow was down 85, NASDAQ was down 1.6%. When I took this snapshot, this is just a listing of all the various spread trades. When I took the snapshot yesterday, when the NASDAQ and Dow are down, my portfolio actually had a $397 profit. So the short positions in these spread trades actually, kicked in, and I actually had a small profit on the same day that, the stock market in general was down big. Now, it recovered yesterday and closed up, but I just thought this was interesting. Yesterday morning when the market was down, taking this snapshot and just showing you these spread trades that actually had a small profit on the day. Here's my second retirement portfolio, and again, I have the various spread trades in this, and this one was down slightly when the broad market was down yesterday morning. So in these two accounts, I currently have $557,000 in open trade profits, and I have an average return of 59%. So you can see that these spread trades are working in this type of volatile markets. And yesterday was really, really volatile. Market was down big in the morning, but then it came back and it closed up big. So this kind of volatility, when you're trying to profit from directional trades, can be very difficult sometimes. So that's why I employ these spread trades. Let's look at the first type of spread trade that I use, which is a bullish debit spread. And with a bullish debit spread, we buy a call option and then we sell a related call option with a higher strike price. So if you buy a call option, sell a call option with a higher strike price, this creates a debit spread. Your risk is limited with a debit spread to the cost of the spread. So regardless of where the underlying stock goes up or down with these debit spreads, the most you can lose is the cost of the spread. And you can initiate these spreads simultaneously, or you can purchase a call option and then sell a call option at a later date to leg into the spread. And I do a lot of legging into my positions. If I have a profitable call option using our trade selection criteria, and I have a profit in that call option, I will sell a call option against that to create a spread, and this can reduce the risk of that directional trade and also increase the profit potential. And I'll show you some actual examples that I took recently with these debit spreads. So I use a three-step selection process to select options with the best profit potential. Step one is we determine the price trend using the 50 and 100-day EMA. Step two is we confirm the price trend, determine the extent of the buying or selling pressure, and then isolate the very best opportunities. And then step three is we select an optimum entry point using the Keltner channel. So this is the basic trade selection process I've been using for decades. I call this prime trade select. So I use this to select call options with the best profit potential. And with options, of course, when you're going to purchase a call option, depending on the stock, there could be thousands of strike prices available for that particular stock. So I use what I call the 1% rule to select an option strike price with a high probability of success. And we've looked into this 1% rule in previous webinars. So if you want to find out what that is, you can look at the some previous webinars and find out how we use this to select an option strike price. That's a big part of the trade selection. So with our option purchase strategy, we use prime trade select to select a stock or an ETF with the best profit potential. and then we use the 1% rule to select the option strike price. So this option trade selection has been very successful for many years, and what we do in my own trading and in my advisory services, we create a market neutral or a debit spread that allows us to lock in profits and reduce the risk and compound our returns. So if we purchase a call option and we get a profit in it, then at a later date we'll create a market neutral spread or a debit spread, and that allows us to lock in the profits and reduce the risk and compound our returns. And I'll show you examples of actual trades that I do day in and day out with these market neutral and debit spreads. So Prime Trade Select has produced a lot of winning trades for us, and then you always have that dilemma when you have a winning trade and you have a profit in an option. At that point, you have to decide whether to hold that option for further upside profit potential, or do you want to take profits in case the stock declines in price, with the possibility of that trade turning into a loss. So whenever we have a profitable call option purchase, we're always faced with this trade dilemma. So what we do is we create these spreads at that point, and then we don't have to make that decision because we're with the spread trade, we're providing downside protection in case the underlying stock goes down in price. And with the market neutral spreads, we not only provide downside protection for that call option purchase, but they don't limit the upside potential. So when you're faced with this dilemma, what should I do if I have a profit in a call option? If you create a market neutral spread, you're not only providing downside protection, but you're not limiting the upside profit potential. Okay, we'll look first at the bullish debit spreads. With a bullish debit spread, the call option that's purchased will profit if the price of the stock increases, and the call option that's sold will profit if the price of the stock decreases. And as I mentioned, your risk is limited to the cost of the spread. And if you leg into a spread, let's say you have an existing profit in the call option, if you leg into a spread, that actually will increase the profit potential of the existing call option purchase, and at the same time, it'll provide downside protection in the event the underlying stock decreases in price. And I'll show you a couple examples of that. Here's a trade I did recently. This is for Cheniere Energy, and I purchased 6 of the Cheniere Energy 40 strike calls at 1260, and I used Prime Trade Select in the 1% rule to select this call option. So after I purchased this 40 strike call, the price of Cheniere increased after I purchased the call option. So what I did was I then sold 6 of the Cheniere 55 strike calls at $6. And whenever you sell to open a call option, of course, cash is credited to your brokerage account. In this case, I sold 6 of the 55 strike calls at 6 points. So $3,600 in cash was credited to my brokerage account. So this cash that was credited to my brokerage account, that provides downside protection. And it also reduces the risk of my call option purchase. So here's my brokerage confirmations, and they show that I bought 6 of the 55 calls. Bought to open 6 of the 40 calls at 1260. Then at a later date, I sold 6 of the 55 calls at 6 points. So this created an option debit spread for Cheniere, and we'll take a look at the risk profile for this. So when I sold the 55 strike calls, the existing 40 strike calls had an open trade profit of 19 points. So when I sold the 55 strike calls for 6 points, this resulted in an increase in the profit potential of this call option purchase. So whenever you sell an option, of course, cash goes into your brokerage account. So in this case, I got 6 points of additional profits on top of the existing call purchase of the 40 strike call. So the sale of the 55 strike call also provided downside protection in the event that Cheniere stock declined in price. And now I'm showing you the call option spread analysis for this trade, where I bought the 40 strike call at 12.60, sold the 55 strike call at 6 points. And the call option spread analysis will calculate the profit loss potential for this trade, assuming various price changes in Cheniere Energy stock at option expiration, in this example from a 10% increase in the stock price to a 10% decrease in the stock price. And this bottom row displays the percent return potential, and it's based on the change in the underlying stock at option expiration. So if Cheniere Energy closes up 10% at option expiration, the spread will produce 127% return. If the stock is flat at option expiration, then it'll still produce 127% return. If the stock goes down 5%, still 127% return. And if the stock goes down 10%, it will produce 100% return. So here's an example of an option spread. Unlike a directional trade that requires the stock to move up in price, here with the spread, the stock can actually move down in price and we can still profit. So this is an example of the advantage of spread trades over directional trades. So we can actually profit if the stock goes down in this case. Here's another, I want to just show you a couple more examples of different time periods with these option spreads. And this was a example of an Apple option spread that I legged into. I bought the 345 strike call at 28.17 on July 8th, then sold the 375 strike call at 24.55 on July 19th. So I purchased the 345 strike call. I had a profit in the call purchase. So 11 days later, I wanted to protect that profit. So I went ahead and sold the 375 strike call at 24.55. And my original risk, of course, with the 345 strike call purchase was 28 points. So that's my initial risk. But once I sold the 375 strike call at 24.55, now my risk in this trade is only $362. So you can see how creating the spreads reduces your risk. And now I'm only risking $362 instead of $2,817. So these are the brokerage confirmations showing the purchase of the 345 strike call at 28.17, selling the 375 strike call at 24.55. So when I sold the 375 strike call, it increased the profit potential of my option purchase by 110%. And it also reduced my risk from $2,800 to $362. And it enabled me to hold my position during volatile price swings. This is one of these periods where the market was very volatile. And by creating this spread, I was able to hold this position during those volatile price swings. And we can see that the return potential for this spread, if Apple goes up 20%, profit potential 728%. If the stock's flat, profit potential of 728%. stock goes down 10%, still have a profit potential of 728%. So this is a great way to trade during volatile markets, because you're gonna make money whether the stock goes up or down, and you also reduce your risk quite a bit by creating these spreads. So this is a good way to trade during these volatile markets, and it's good, I think, to hold these spread trades and make them part of your portfolio. Here's the Apple debit spread risk profile. Maximum risk was $362, profit potential of $2,630 for this spread per contract. Here's one more example. This was for MasterCard. I bought the 330 strike call at 23 on October 24th, and then sold the 360 strike call at 20 points on November 3rd. So this is about a 10-day period. Purchased the 330 strike call. I had a profit in it, so I wanted to protect that profit. So I went ahead 10 days later, I sold the 360 strike call at 20. So this reduced my initial risk of $2,300 down to $300. So again, by creating this spread, I drastically reduced my risk. So let's just review these option spread advantages. They increase the profit potential of your option purchase. When you leg into a spread, sell a call option, you can increase the profit potential of your option purchase by 30 to 100% or more. And we saw in the example of the Apple spread trade that it increased my existing profit potential by 110% by selling that 375 strike call option. They provide downside protection. The sale of the call option results in cash being credited to your brokerage account, and they reduce the cost basis of your option purchase. And the short call profits if the underlying stock moves down in price, so they provide downside protection. And creating these spreads can reduce your risk. We saw in the Apple example, reduce the risk from $2,800 to $362. With MasterCard, reduced the risk from $2,300 to $300. So it's a great way to trade when you have this kind of a market with a lot of up and down moves, but very little trend. And once again, these spreads can be profitable whether the stock increases in price, decreases, or remains flat at option expiration. So let's just look at some real-time results from previous years with this strategy. I had $919,000 in real-time results, average return of 58%. There was 130 winning trades and 11 losing trades, so it was about 92% accurate. So what I want to do is just show you these snapshots of these portfolios over the last several years, and just give you an idea of the profitability that I've been experiencing with this spread strategy over the last several years. So here's a snapshot of a portfolio, $175,000 profit, average return 95%. This one had $118,000 profit, average return of 99.7%. So this just gives you an idea. These list the various long and short calls, and just gives you an idea of the profitability during various market conditions over different time frames. So I'll just run through these. Okay, and here's the current option spread open trade profit results for my advisory service, and this lists the trades and the profit for each trade, percent return, and the portfolio currently has $104,000 open trade profit, average return of 490%. Okay, and let's talk about the market neutral spreads now. And with the market neutral spread, you buy a call option and then you buy a put option, and you can purchase the call and put option simultaneously, or you can purchase a call and then purchase a put option at a later date to leg into the spread. So just like the debit spread, you can leg into these, or you can trade the spread simultaneously, buy the call and buy the put simultaneously. And let's look at some of the attributes of the market neutral spread. The call option that you purchase, of course, will profit if the price of the underlying stock increases. The put option you purchase will profit if the price of the underlying stock decreases. And your risk is limited to the cost of the spread. There's no limit on the profit potential of the spread if the underlying stock continues to increase in price. And I'll show you an example of that. So just like the debit spreads with the market neutral spreads, I use the Prime Trade Select three-step process to select call options. And again, the three steps are we determine the price trend first using the 50 and 100-day EMA, then we confirm the price trend, and then select an optimum entry point using the Kettler channel. So this is the basic three-step process I've been using for decades to select options with the best profit potential. Then we use the 1% rule to select the option strike price. And the Prime Trade Select, as I mentioned, has produced a lot of winning trades. So again, once we have a profit in a call option, then we have to decide whether to hold that trade for further upside potential or to take profits in case the underlying stock declines in price and the option trade could actually turn into a loss. So by creating this market neutral spread, we don't have that dilemma because we're not limiting, when we create the market neutral spread, we're not limiting the profit potential of the call option purchase. And at the same time, we're providing downside protection when we purchase that put option. So this allows you to avoid this dilemma of whether you should exit your position when you have a profit or keep the position. So, and as I mentioned, it's a great way to trade during volatile market periods. So,
Chuck, I don't want to interrupt you, but there's a lot of people asking for Prime Trade Select, and Chuck has actually done webinars that focus on that and the trade selection process. So you can go back to the webinar archives that Chuck has up to review this, which will help you with what Chuck's covering today. Chuck, sorry for the interruption.
Oh, yeah, no, thanks for mentioning that, Tom. Yes, we go into detail on Prime Trade Select. I'm just mentioning it today so you can understand the process we go through to initiate these option spreads. But yes, I go into detail on Prime Trade Select and the 1% rule in previous webinars. So if you want to see how we implement that Prime Trade Select, just look at the webinar archives. Okay, and again, with these market neutral spread trades, if you purchase a call option and the option increases in value, and then you purchase a put option at a later date, it does not place a cap on the profit potential of the existing option purchase, and at the same time, it also provides downside protection in the event the underlying stock decreases in price, and I'll show you some examples of that. Here's a trade I did recently for 3M, and I used Prime Trade Select to select a 3M for a call option purchase. And I purchased 3 of the 100 strike calls at 27 points, and I used the 1% rule to select this 100 strike call option because that had a high probability of success using this 1% rule. So purchased three of the 100 strike calls at 27. So I was able to get a low risk entry using the prime trade select, and this call option purchase, the 100 strike call option purchase, was successful and the trade was profitable. So at that point, I had to decide whether I'm going to hold that trade for further upside profit potential or take profits in case the stock declines. So in order to avoid that dilemma, I created a market neutral spread, and I purchased three of the 3M 135 strike puts at one point to create the market neutral spread. So this allowed me to lock in a profit for my 3M trade regardless of the price movement of 3M stock. And at the same time, my upside profit potential was not capped by buying this 135 strike put. So again, this is a great way to trade because it allowed me to lock in an existing profit regardless of the trade, regardless of the price movement of the underlying stock, and at the same time, my profit potential was not capped. So as 3M stock moves up in price, my profit potential increases, and I'll show you an example of that. Here's my brokerage confirmation showing I bought three of the 100 strike calls at 27, bought three of the 135 strike puts at $1. So let's look at the risk profile for that. And the market neutral calculator will calculate the profit potential for the spread trade, assuming various price changes in the underlying stock at option expiration. And this bottom row here displays the profit potential. So we can see that by creating this market neutral spread, my profit potential was not capped as the stock moves up in price. So if 3M stock is up 10% at option expiration, I'm going to have a 75% return. If 3M stock is up 20% at option expiration, I'm going to have a 124% return. If it's up 30%, I'll have a 172% return. So you can see as the stock moves up in price, your profit potential also moves up in price. So the profit potential is not capped. If the stock's flat, I get a 27% return. And then you can see if the stock goes down, my minimum return is going to be 25%. So this enabled me to lock in a 25% return for this trade no matter what happens to the stock. And also with these market neutral spreads, if the stock declines substantially, then your return also starts going up. So this is a great way to, if you have a profit in a call option purchase, to protect that profit, and in this case, guarantee a profit. And at the same time, if the stock keeps moving up in price, you're going to continue to profit. Here's another example. This is for Cigna, the insurance company. You can see right here, this is a price chart of Cigna at the time, and the Keltner channels overlaid the daily price movement here with the top blue line is the upper Keltner channel, the middle line is the dotted line is the middle channel, and the lower line is the lower Keltner channel. So the idea behind the Keltner channels is you want to buy these call options when the stock has sold off, and this allows for a low risk entry. We can see right here the stock sold off down near the lower channel, and at that point I went ahead and bought the 50 strike call at 17 points. So this is just an example of the prime trade select Cigna was on a 50 and 100-day EMA buy signal. We confirmed the price trend with the on-balance volume, and Cigna was making a series of new 52-week highs. So that confirmed the price trend, and then step 3 of Prime Trade Select is we wait for the stock to become oversold before we make our purchase. And we purchased the call option right here, and you can see that allowed for a low-risk entry as the stock didn't retrace after this. I purchased the option. So this is just an example of how we use the Prime Trade Select to select a call option purchase. So my low-risk entry with this 50-strike call option purchase was successful, and the trade was profitable. So what I did was I purchased the Cigna 72.5 strike put option at 142. Now this created a market neutral spread with my 50 strike call option purchase, and we'll see with the market neutral spread calculator, which I'll show you next. This allowed me to lock in a profit for the trade regardless of the price movement of CI stock, and at the same time my profit potential was not capped. And we can see Cigna stock at the time trading at 76.36. I bought the 50 strike call at 17. Bought the 72.5 strike put at 142. And we can see this allowed me to lock in a profit. This bottom row here shows the percent return potential for this spread trade, assuming various price changes in Cigna stock in the top row here of the calculator. And we can see if the stock is flat at option expiration, I get a 43% return. If the stock declines, I get a 22% return. And if the stock declines sharply, then I get the return starts to increase. And then, again, it didn't cap my profit potential. If the stock was up 10%, I got an 84% return. If the stock's up 20%, I got 126% return. So again, your profit potential was not capped with this. And at the same time, it allowed me to lock in a profit no matter what happens to the price of the underlying stock. And here's one more example I wanted to show you. When we get to option expiration with these market neutral spreads, and the spread is profitable, then you're faced with another dilemma. Should you roll over the market neutral spread, or should you close the position? So what we do is, if the stock is still on a Prime Trade Select buy signal, then we'll roll over that market neutral spread. And when you roll that over, you're rolling over the profits, and those profits allow you to reduce the cost basis of the new spread and allows us to compound our returns. And I'll show you an example of that. This is an example of a Costco option purchase. I purchased the July 95 call at 1540, and then I closed out that July 95 call at 2257. So I had a 7-point profit on this option purchase. So I rolled that over into a market neutral spread, and it reduced the cost of the new spread by 717. So I rolled over the July 95 call into the August 105 call. And here's my brokerage confirmations showing that I bought the August 105 call at 1265 and bought the August 115 put at 103. So that created a market neutral spread, and the 717 profit on the closeout of the July call reduced the cost basis of this spread from 1265 to 548. So when you reduce that cost basis, of course, that reduces your risk and allows you to compound your returns. And we can see that once I rolled over the profits into the new spread, now my minimum return, no matter what happens, is 100%. And it allows us to compound our returns. A 10% increase in the price of the stock would result in a 282% return, and a 20% decline in the stock would result in a 215% return. So by rolling it over, I reduce my cost basis, and of course this will increase the percent returns once your cost basis is reduced. And then I rolled the August market neutral spread into the September spread, and now I reduced my cost to almost zero. And here's the actual spread trade I used to roll over. I closed out the August 105 call, bought the September 115 call. So I like to use these spread trades to roll over options to reduce the cost of the bid-ask spread when you're trading options. So this is the actual option spread order I used to roll over the trade. And here's the closeout, the spread trade that closed out the August put and then bought the September put. Now, with the reduced cost basis, my minimum return is going to be 1,090%. And of course, this percent return gets bigger on this bottom row here as your cost goes lower. So minimum return for this spread would have been $458, which is 1,090% return on my reduced cost basis. And then as it turned out, after I established that September market neutral spread, the price of Costco stock declined down to the 110, 112 area. And if I had just purchased that call option, the 115 strike call option, and I didn't purchase the put option, I would incur 100% loss if the stock closes below 115. So that just shows you that these market neutral spreads can really help protect your position if the stock declines. So if you buy the September 115 call and the stock closes below 115, you have 100% loss. But in this case, I had the market neutral spread, and I was going to get a 1,090% return regardless of the price movement of Cigna after I established that spread. So that just shows you the advantage of a directional trade call option purchase versus the return potential for an option spread, which guaranteed me to have a profit. And lastly, I'm just showing you a snapshot of my retirement portfolio. And what I did is I highlighted the market neutral trades here. And I had an average return of 264% for these market neutral trades. These were for Best Buy, Cigna, J&J, Micron, Starbucks, and Yahoo. So at the time I took the snapshot, these had an average return of 264%. And then what I did is I went through these trades and put them into the market neutral calculator, and the minimum profit for this portfolio, no matter what the stock did, was 186%. So that was my minimum profit for this portfolio, regardless of the price movement of the underlying stock. Here's the second half of that with the Micron, Starbucks, and Yahoo market neutral trades. So this average return of 264% and a minimum return of 186% shows you this is a really good way to trade options. And when we roll over these market neutral spreads it allows us to reduce the cost basis of the new trade and then compound our returns. It also allows us to lock in profits regardless of the price movement of the underlying stock. So a great strategy during volatile markets. And lastly, this is a snapshot of the advisory service market neutral portfolio. Currently have $166,000 profit, average return of 285%. So that concludes my presentation. If you'd like to get updates on the profits of these various strategies, you can just log on to weeklyoptionalert.com and then click trade results, and it'll show you the open trade results for these various strategies: market neutral, option spreads, call option purchases. So you can get this is updated with current prices, so you can get an idea of what these various strategies are currently doing by just clicking trade results. Or you can call Brad toll free to get an update on the various strategies. So that concludes my presentation. I'd be glad to take any questions.
Chuck, we're getting a lot of questions regarding the environment right now in the marketplace. Where would you start before? Well, I mean, what is the first thing you would use before you implement? Is it the 52-week highs? Is it the trying? Where would you start to come up with a trade selection?
Okay, yeah, that's a good question. During these volatile markets, you got to be really careful of your entry timing, because if you have bad entry timing, obviously you can be stopped out. So if you use that prime trade select and you use those Keltner channels to only buy an option or the stock when it's oversold, that can help reduce the risk, that entry timing risk. And that's the way we do it, and we'll wait for that stock. If it's in a price uptrend, using the 50 and 100-day EMA, and the price trend is also confirmed by the stock making a series of new 52-week highs in an upsloping on balance volume line, then we'll wait for that stock to retrace down towards the lower Keltner channel before we'll purchase a call option. So if you use that prime trade select, that can help you get a low risk entry into an option purchase. And then if you have a profit in that option, then at a later date, you want to either create a debit spread or a market neutral spread. I trade both ways. I trade both strategies, and that'll allow you to protect those profits and at the same time participate in any further up move in that stock.
Chuck, we noticed that you do you show a lot of the trades in the IRA. Would you set your time frame in your options the same as an individual account as an IRA, or your time duration on your options different?
Yeah, that's a good question. The selecting the time duration on the options, and I would use the same expirations in my retirement account as I would in a regular brokerage account, and I usually go out 1 to 2 to 3 to 4 months out when I purchase an option, and I'll use various expiration dates: 1 month out, 2 months out, 3 months out, and then as I get close to option expiration, if the trade is profitable and the stock still qualifies under prime trade select, then I'll go ahead and roll that over for another 2 or 3 or 4 month option.
Okay, for those of you that don't know, Chuck has been kind enough. Chuck, I'm gonna make myself the presenter so I can show the attendees some of your past webinars.
Okay.
But we are getting a lot of questions regarding the basis of these trades, and Chuck was kind enough to do a 2-part webinar series. And in this webinar series, he actually came in and spent a lot of time showing his trade select process from A to Z. So right around here, this is mytrademonster.com. You could see the webinars right here on the right-hand side, and Chuck has the most archived webinars with us of any author. And Chuck, obviously, we thank you for that. But for those of you that want to go back, see these archives, download them, or just pick up the phone and call Chuck's support staff, they can address a lot of these questions for you. Chuck, thanks again for coming out today. It was a pretty lengthy webinar, and we have so many questions to ask. I'm sure you're going to be getting some phone calls from some of the attendees.
Okay, sounds good. And thank you again, Tom, for taking the time to set up the webinar.
Happy to do it. And for those of you that do have any questions for Chuck Hughes, don't be shy. Contact his support staff. If you have any questions regarding webinar archives or the brokerage end of it, feel free to contact us at mytrademonster.com. Otherwise, Chuck, hopefully we'll see you next month.
Okay, sounds good, Tom.
Okay, Chuck, thanks for coming out, and thanks for everyone else and all the attendees. And just remember, trade smart, trade hard, and trade like a monster. Good night, everybody.
Good night, everybody.